Hey guys, Justin here with Deep Dive Stocks with another video. Today's video is going to be on liquidity, or how smoothly things are running in the market. This is going to be the first part of a two-part series covering some fundamental concepts of the stock market. Well, let's get started. So liquidity is an interesting concept. It's elusive, and like most things in the market, is defined a whole bunch of ways. If you've seen Deep Dive Stocks video on Delta, you'll start to notice that this is a pretty common theme. This makes liquidity difficult to pin down at first, but it can be pretty useful once you do. There are three ways that liquidity can help us understand the market. The first is by showing us how smoothly things are running. The second is by showing us the cost of maintaining a stable position or price. And the third is by showing us the market's expectations of price movement. Let's look at an example to help get us started. Let's suppose we're at our market center and our neighborhood trader Sally has an apple to sell and she thinks the fair price for this apple is $1. She arrives in the market and loudly states, "I'm selling an apple for $1. Before she can step away, another trader runs up and says, "That's a great deal, I'll buy that apple for $1. Both traders perform their trade and they walk away satisfied, having fulfilled their needs. Well, this was a pretty easygoing situation. Some might say it was even rather fluid. But suppose the situation went slightly differently. Our trader enters the marketplace as before and proclaims, "I have an apple to sell for $1. This time, however, when the other trader approaches, they state they don't agree with that price. "I'll only buy your apple for 50 cents, she says. Well, now there's a predicament in the market. Does our neighborhood trader Sally sell her apple for less than she thinks is a fair price? Does she wait for someone else to come by who's willing to purchase the apple for $1? Finding out answers to these questions are made more difficult if there are some requirements that are mandating that Sally sell her apples. Since the situation is not as liquid or running as smoothly as it was before, we could say that liquidity has been removed from the market. Let's look at how this example can help highlight the three ways of defining liquidity. When the bid from buyers and the ask from sellers are about the same, the market is running smoothly. Sally can sell as many apples as she likes because, well, there are always buyers. But if one side starts to expect more for their trade than the other side, then things can stall quite quickly. And that's what we see here in our example. So how do we quantify this experience to help guide us in the market? Well, we use a metric known as implied volatility. Implied volatility is the measure of how well things are flowing in the market, and it's calculated a whole bunch of ways. But thankfully, we're not going to get into that just now. For now, let's mainly focus on the three pieces of information that implied volatility can give us, starting with how implied volatility is measured. In our example with Sally, we saw that when things weren't running smoothly, neither the buyer nor the seller could fulfill their transactions. Here we would say that there was little liquidity in the market. When liquidity is removed from the market, implied volatility rises. This is a good relationship to memorize. Now we're going to move on to how implied volatility can help us understand the cost of stability. Remember when Sally wanted to purchase and sell the apple for $1 and Betsy the buyer was willing to purchase the apple for $1? When two traders trade an asset, it establishes an agreed value of that asset. In this case, it established the apple's price as $1. Since the situation had a good amount of liquidity, that means implied volatility was low. But what was the price of the apple when the two traders didn't agree? Well, let's look at that again. When Sally and Betsy didn't agree, that means the situation wasn't very liquid and had high amounts of volatility. Now let's suppose that Betsy the buyer isn't just buying apples because she wants them, but rather she needs them in order to bake pies for her business. Well, this need or obligation to purchase is going to affect how the scenario plays out, which ultimately will have an effect on the value of the apple. You see here, Sally's valuation of the apple is $1 and Betsy's is 50 cents. But unfortunately for Schrödinger, not everything can take on multiple states, so a decision must be made. Well, we are going to see that the value of the apple isn't just about the apple. Suppose that if Betsy doesn't obtain this apple, she can't make her pie. And if she can't make her pie, she can't keep her business open. Thus, Betsy is coming to the market with a need, and needs have costs. So Betsy came to the market to purchase an apple to keep her business open, and she expected to pay 50 cents for the apple, but she wasn't met with success. Betsy must ask herself what she is willing to spend in order to keep her business open. If it is less than 50 cents, then it makes sense for Betsy to purchase the apple at $1. Thus, Betsy is demonstrating to the market that for her, the apple is indeed worth $1. So returning to the market, we see that Betsy arrives to purchase apples, with the cost of maintaining her position as a business owner attached to the expected cost of the apple. Since 50 cents is an allowable cost for Betsy, she agrees to pay $1 for the apple. Thus, for Betsy, the cost of stability when volatility was high increased the price of the asset by 50 cents. Well, let's say things get worse. Let's say Sally has been met with a case of the Mondays and she's feeling quite vindictive. She knows that if she continues to raise the price, Betsy will have to purchase the apple at that price. She needs to keep her business open. And so she does just that. She raises the price to $1.50, which is even further from Betsy's ask. This spread in the bid and the ask reduces the ease with which Betsy and Sally can trade with each other. Since things are less fluid, there's greater volatility. But again, since Betsy needs to purchase this apple or else she won't be able to make her pie and thus she won't be able to keep her business open, she has no choice but to accept Sally's terms and purchase the apple at $1.50. When the bid agrees to the ask, the price of the asset increases. So now the market's valuation of the dollar is $1.50. And the cost of stability has risen by $1. So when looking at the cost of stability in the market, we notice that as liquidity diminishes and volatility rises, the cost of interacting in the market to maintain a particular position increases. In this case, Betsy wanted to maintain her position as a business owner, so she was willing to spend more money for the apple. Now we're going to move on to the last way of viewing liquidity in the market, and thankfully we've already seen it. Remember when both traders agreed that the value of the apple was $1? In this instance, liquidity was high and volatility was low. Both traders left, securing their relative positions at their expected price. This means that the price of the apple did not have to change. Yet when liquidity diminished and Betsy valued the apple at 50 cents, implied volatility rose. And since Betsy had to purchase the apple, the bid had to rise to the ask, and thus the value of the apple increased. Then, when implied volatility rose even more and liquidity diminished even more, the bid had to increase the valuation of the apple even more to fulfill their position. This rose the value of the apple even more. So there seems to be an association with volatility and the amount of movement that an asset can experience. And indeed, that is what we see. So as implied volatility increases, the market expects the price to move a greater amount. This expectation of price movement can be very useful to keep an eye on. And that's what we see here. So as liquidity diminishes, implied volatility increases, and then price can move more. Wow, that was a lot. Today we learned 3 important things about liquidity and the tool that we use to measure it. We saw how implied volatility can measure the liquidity of a stock or how easily trades are going back and forth. Then we applied that knowledge to the determination of the cost of one's position. So Betsy needed to purchase apples in order to keep her position secured, so it rose the value of the apple. Then we saw that because of the way that the bid and the ask spread works, that as the liquidity diminished, the price of the value of the asset could move in greater ranges. So that's liquidity in a nutshell. Thanks for watching, and I'll see you guys next time.